Hi everyone, so today I want to do a video on QFIN or 360 Finance, which is a Chinese investment company that operates in Shanghai. So we can see the brief description here. So it's a primary tech-driven company, lending to its partners under the 360 Group, which is a large conglomerate in China. So it's traded on the Nasdaq and it was IPO'd 2018. Trading at $16.50, which is currently at $11.49. So what really interests me about this company is just the sheer amount of growth it's seen recently, along with the relatively low PE ratio and also the very low amount of debt. So if we come down to the income statement, just as a brief touching point of showing what sort of got me interested in this company, so we can see here that throughout annually, the revenue is increasing dramatically. It's got a relatively high operating margin. It's got a low debt to equity. We will find out some of these other statistics soon. And we can also see that it has positive cash from operating activities, which is growing quite largely. So going to a website I like to use called Simply Wall Street, and this just gives a sort of great summary of what the company's like and the sort of the financial health of it, the future earnings and the valuation of it. So if we come here, we can see just a brief summary, which will run down each point in a second. So it's trading at 79% below the fair value, and I found that this fair value is generally quite good. It uses the excess returns model, which is typically for finance and banks, which have a low amount of assets but sort of deal with a large amount of money. So if we go down to the valuation tab here, and what I like about this as well is it has a checklist of what you can use. So we can see here that the valuation is 79% undervalued, so its price is currently $11.49. The fair price of how much cash it can generate in the next couple of years is at $54.82. So huge returns there, over 500% if you buy it now, based on if the fair value is correct. So the PE ratio, is 5.2 compared to the finance industry's average of 7.5. The good value compared to the US market at 18.5. What's really good to see is it's got a PEG ratio, so PE price per earnings over growth is at 0.2, which is anything the lower the better with this one. So it's showing that it's really undervalued compared to the future growth that's reported for it. The only negative is it's got a relatively high PB ratio, so price to book ratio. However, it being a financial company, it doesn't have as many assets, so it's something to consider, but it's still quite high compared to the US finance industry's average at 1.1. So coming to the future growth here, and we'll look at the financial report in a second, just to sort of back up where this website's getting the information from. So we've got forecasted annual growth, earnings growth of 29.5%, which is very high. We can see here that the revenue is forecasted to grow quite a lot, with quite a high margin of earnings for the revenue. The free cash flow is also currently quite high, so that the cash flow never dropped negative. It did in March 2019. However, the revenue kept up, and that was under a large part of growth for the company. We can see here that the company has a forecasted annual revenue growth 14.3 compared to industry at 8.8. The EPS is going to show, and the return on equity is very high at 30%, which is what you'd like to see compared to consumer finance average at 16.5%. We can see here that it's had 63% annual growth in the last 5 years. If we go to the financial health tab here, we can see that it's got a large difference between the assets and the liabilities shown graphically here. So we've got debt at a 2.7 debt to equity ratio, which is absolutely insane. The one negative here is insufficient data to determine the debt to equity over the last 5 years. However, the graph only goes to 2016, so it had initially a debt to equity minus 352% as it launched. Back in 2017, it had 100%, and now it's managed to squash that down to 2.7. So the better the debt, the lower the debt, the better the company's health is. It doesn't pay a dividend. However, if we go to the management section here, we can see that the president they are quite young, so average 32, average 10 years 0.2. However, the largest shareholder here, Hong Yi Zhao, owns 12.4%, and he is actually the owner of the 360 Group. So if we go do a bit of research on him here, which is he founded 3721 in '98. He sold it to Yahoo back in 2004 for 120 million, with him then leading Yahoo's China operation. However, they fell out and Yahoo sold it to Alibaba in 2005, which is when he went to start QFIN, the group owning 360 Finance. So he is a Chinese billionaire, and he's ranked 45 in China's Rich List 2018. So he's a good person to have on the board. It shows his experience in the tech industry. I haven't done too much research into him, but I feel like, it's better than some run off the street who's got no experience in this sort of industry. And what is interesting to see is that shareholders have bought a large amount of shares in the last 6 to 9 months, so 18 million, with no insiders selling. And we can see individual insiders own 22%. So one of Warren Buffett's main rules is you want the individuals running the company to be invested in how the company sort of performs. It's a bit more liable. And then we're starting to see some more Western companies such as Morgan Stanley, BlackRock, Vanguard, and some other similar capital management companies from the West buying into this. So we can see here Morgan Stanley's increased their holding by 3,103%, BlackRock by 168%, and Russell Investment by 129%. So if we go to the recent Q2 financial report released August 23rd, 2020, the main take-home points here we can see increase of revenue at 21%. One of the best things, one of the highlights for me is the increased length of the loan, so 8.54 compared to 7.76. The amount of registered users grew 36% from 109 million to 148 million, so it's got a huge customer base. And we can see a delinquency ratio of 2.87, so that's the amount of people who sort of default on their loans divided by the total number of loans. Comparing this delinquency ratio here of 2.82, that is quite high compared to the, so looking here at the US Federal Reserve, see delinquency rates typically in the last quarter have been about 1.98, 2.47 before, so we can see it's slightly on the high side. However, it's still not a large cause of concern, but that is one risk factor for me. Another thing to consider as well is Chinese regulation. So a company here, QFIN, if we look at their share price, it recently has tanked significantly. So IPO'd at 33 and went down to 182. So doing a bit of research, we can see that's a Chinese government crackdown on microlending. So it's good to see that the 360 Finance hasn't had those issues. This was predominantly down to lending, this company here, down to lending to sort of poor credit rating. However, with the delinquency ratio here of 2.82, it does look promising. So that's my analysis on QFIN. I'm going to be increasing this. This is going to be my largest portfolio holding, hopefully in the future. With this sort of upside and little downside, I think it's definitely worth adding to your portfolio. So let me know what you think in the comments, and thank you very much.